Another day, another story. In the world of business finance, there are various avenues to raise capital, and equity financing stands out as a popular option. Equity financing involves raising funds by selling shares or ownership stakes in a company to investors. In return for their investment, these investors become shareholders and have a claim on the company's profits and assets. We will explore equity financing in detail, discussing its benefits, examples, and implications for businesses. Benefits of equity financing. Access to capital. Equity financing offers businesses an opportunity to raise substantial amounts of capital. Investors are often attracted to companies with strong growth potential, innovative ideas, or a track record of success. This influx of funds can be used to expand operations, develop new products, enter new markets, or invest in research and development. Shared risk. Unlike debt financing, equity financing does not require regular interest payments or fixed repayment schedules. Investors assume a share of the business's risk and reward. If the business struggles, investors may experience a decline in the value of their shares or even a loss. However, if the business succeeds, both the company and its shareholders stand to benefit. Strategic partnerships. Equity financing often brings more than just capital to the table. Investors, particularly those providing venture capital or private equity, often possess valuable industry knowledge, experience, and networks. They can serve as strategic partners, offering guidance, mentorship, and access to potential customers or partners. Examples of equity financing. Initial public offering, IPO. An IPO is a significant example of equity financing. It occurs when a private company offers its shares to the public for the first time, allowing investors to buy ownership stakes in the company. This process involves thorough regulatory scrutiny and typically results in a substantial infusion of capital, enabling the company to fund its growth plans. Venture capital, VC, funding. Startups and early-stage businesses often rely on venture capital firms to secure funding. Venture capitalists invest in companies with high growth potential and expect a significant return on their investment. In exchange for their capital, venture capitalists acquire equity stakes in the business and often play an active role in its strategic decisions. Private equity, PE, investment. Private equity firms invest in established businesses that require substantial capital for expansion, restructuring, or acquisition purposes. These firms typically buy a significant stake in the company, often taking a controlling interest. They work closely with management to improve operations, increase efficiency, and drive growth, aiming to sell their shares at a profit in the future. Implications and considerations. Dilution of ownership. Equity financing involves selling ownership stakes, which means the founders or existing shareholders may experience a dilution of their ownership percentage. It is crucial for business owners to carefully evaluate the amount of equity they are willing to part with and the potential impact on decision-making and control. Reporting and transparency. When a company sells shares to external investors, it often becomes subject to increased regulatory and reporting requirements. Publicly traded companies must comply with financial reporting standards, disclose relevant information to shareholders, and adhere to corporate governance guidelines. Exit strategies. Equity financing often implies a long-term commitment from both the business and its investors. However, investors eventually seek an exit strategy to realize their returns. This may involve an IPO, a sale to another company, or a management buyout. Business owners must consider the expectations of their investors and plan for potential exit scenarios. Equity financing offers businesses a powerful tool to raise capital and propel their growth. It provides access to substantial funds, shared risk with investors, and potential strategic partnerships. Examples such as IPOs, venture capital funding, and private equity investment illustrate the diverse opportunities available through equity financing. However, businesses must carefully consider the implications and trade-offs associated with equity financing. Dilution of ownership, increased reporting and transparency requirements, and the need for well-defined exit strategies are important considerations. It's essential for business owners to weigh the benefits against the potential loss of control and long-term commitments that come with equity financing. By thoroughly evaluating their financial needs, growth plans, and the alignment with potential investors, businesses can make informed decisions regarding equity financing to unlock their full potential for success. Thanks for watching.